Well, I'm glad to see everybody back for chapter 10. April finally warmed up a little bit. Figured I'd crack out the short sleeves. Left the sunglasses in the car though. Anyway, hopefully all that coronavirus stuff is past and the stock market's back up and baseball maybe is starting again. So let's get right to chapter 10. Keep this video a little shorter than the last one. Not many definitions, just a couple that you'll have to get into, but let's get going right away. Hopefully you've already read the notes, maybe even taken a look at the homework problems. All right, chapter 10, weighted average cost of capital is coming into play. We're going to finally start calculating it. You're going to calculate it. It's not going to be given anymore. All right, what do we need to know? To do it, we need to know our targeted capital structure. Okay, every major firm, board of directors, we talked about them in chapter 9, are going to help the executives determine what the targeted capital structure is. It's a long-term perspective. Okay, targeted capital structure is a long-term perspective. You don't change it day to day, month to month, not even really year to year unless something dramatically changes. Okay, why? Because investors want to know what you're expecting to do in terms of your long-term financing. In the case on the board, we've decided our target structure is 40% bonds, 50% common stock, and 10% preferred. So again, we're building on stuff that we learned before. All right? So investors are expecting this. So as you raise new money, if you're going to raise $10 million more, we're expecting you to sell $4 million in bonds, $5 million in common, and $1 million in preferred. Now that's your long-term perspective. However, situations may mean that you might one year issue more bonds or more stock or more preferred. But over the long run, you'll adjust and get back to your target structure of 40, 50, 10. This is just an example. It could be any three percentages based on what's appropriate for your firm. If you got a question, send me an email. Okay, now 40% bonds, 50% common stock, 10% preferred. The other thing that we have to keep in mind is what is the tax rate, because that will impact the calculation of weighted average cost of capital. Okay, now we said it's a long-term perspective. Here we are coming out of a little bit of a mini financial crisis, hopefully, where the Fed dropped interest rates. Well, if interest rates drop dramatically and you're a top-rated company, you might want to issue some bonds, because maybe you're normally paying 7%, and if you're a good rated company, for your longer-term bonds, maybe you could have caught a cheaper rate, maybe issued your bonds at 5 or 6%. Okay, so if all of a sudden there's a blip in the market that interest rates are cheaper and you can issue bonds, we might issue all bonds this month, no stock, no preferred. We're taking advantage of the lower rates. Think about it also. We know stock prices have come down dramatically. Right? Do I want to sell new stock at a depressed price? If I'm Boeing, do I want to sell shares of stock at 170 when they were 350 a month ago? No. Tesla did a wise thing back in end of February. Their stock popped near 900. They came in and issued shares. They didn't sell debt at that time. They just sold shares of stock. They sold shares of stock because the price had approached 900. They got a really good price for issuing stock. Earlier in 2019, they did an offering where they sold both bonds and stock. The stock price was lower. The interest rates were okay, so they issued some of each, probably in line with their target structure. Okay? So even though this is a long-term perspective, in the short run, you might deviate. In Tesla's case, they sold all bonds. Some companies right now, better capitalized companies, will sell just bonds right now. Tesla, we said, sold all stock in their last round of financing. Okay? It's going to depend. The opportunities in the market will dictate your day-to-day movements, but long-term, you're gonna head back towards these percentages, okay? All right, why do I have tax rate up there? We have tax rate up here because it influences only one item. It influences the bonds, the cost of our debt. So if we're selling bonds for 7%, that is not our after-tax cost of bonds. We get a break. We talked about that in Chapter 9. One of the reasons to sell bonds is because the government subsidizes it to the firm selling it. You get to deduct your interest cost on the income statement. So here's the formula you need to know to adjust for what the true cost of the bonds are. It's rather simple. It'll be the rate you're paying, 7%, times 1 minus T, where T is the tax rate. Okay? T is the tax rate. So, given that our tax rate is 30%, that's going to be 7% times 1 minus 0.30, or 7% times 0.70, which should give us 4.9%. The after-tax cost of debt is 4.9%. Okay? You're paying the investor 7%. The investor that buys your bond gets 7%. They'll pay taxes on it. So their net after-tax earnings is going to be less than 7%, but we're not worrying about what the investor does. We're trying to calculate our weighted average cost of capital. You pay the investor 7%. The government gives you a tax break because you deduct it. You're shielding 30% of the cost. Your after-tax cost of debt, you have to understand, simply 1 minus the tax rate, 4.9%. So when we're figuring out our weighted average cost of capital, we won't use the 7%, we will use the 4.9% after-tax cost of debt. These two items, common and preferred, do not get a tax break. No tax break to the firm selling the stock. We said the people that invest get a break on dividends. They don't pay the same rate as the rest of their taxes. The firms that issue it don't get it. So we will use the 12 and the 9 and the 4.19. Now it should become a simple problem. The one trick is when you're reading a problem, a homework problem or a test problem, did I tell you it was a 7% before tax, or did I tell you it was the 4.9 after tax? If I told you we used the 4.9 after tax, then you just go right to doing the weighting. If I told you it was a before tax cost of debt, you need to use the 1 minus T to get to the 4.9. Thoughts, concerns, questions? Hopefully everything's clear. All right, everybody's staying awake. It's a nice day outside. Let's get this over with. Okay. All right, so what do we need to do to calculate the weighted average cost of capital? We need to first erase the board to give us a little room. And all we got to do, something you've been doing already, is take 40% times 4.9. 40% times 4.9, which is 1.96%. 40% of the after-tax cost of debt is 1.9%, 1.96%. 50% of 12% is 6%. And 10% of 9% is 0.90%. Add those together, we get 8.86%. That is your weighted average cost of capital. No longer will I give you the weighted average cost of capital. You can now calculate it. Rather simple. The one trick, make sure you're using the after-tax cost of debt. not the before tax cost of debt, and then just multiply by the weights of how much you have invested in each, actually not invested, how much you have issued in each one of these different securities. Some companies don't issue preferred. Then the bonds and the common stock would have to equal 100%. It might have been 40-60, 70-30. Okay, you don't have to issue preferred stock. All right? If you got any questions on that, make sure you know where your decimal points line up. All right, and we'll do another problem. Okay, we are going to, let's see. Jump to a new problem, changing the tax rate to 40%. All right, so this is going to change. We'll make this 9%, 14%, and 10%. Our weighting will go to 60, 25, and 15%. This is the before tax. This is the before tax. Cost of financing debt. That's what you're paying the investors. The government's giving you a 40% tax break, so we take 9% times 1 minus T. That's 9% times 1 minus 0.40 in this case. 9% times 0.6 gives us 5.4%. That's our after-tax cost of debt. Okay, so now we know we are going to use 5.4% here. These we're using just what they are. This is the only one that gets the tax effect. And what do I have? 60% of 5.4. 3.24%. A fourth of 14% is 3.50%. 15% of 10% is 1.50%. That totals up to 8.24%. Okay? So what does this mean? This is our weighted average cost of capital. This means when we're going to invest in projects, the projects have to be earning greater than 8.24%, or we don't invest in the project. If the project comes back and it can earn 7%, don't invest in the project. If the project can earn 10%, invest in the project. Okay? There may be some other non-financial considerations on the ones that look like they're good, but from a purely financial perspective, this is your key. Has to earn more than 8.2%, or don't invest in the project. That's what we're using weighted average cost of capital. Okay, to determine what our financing costs are and to determine if projects that are presented are worth investing in. Okay? Now we noticed it dropped to 8.24. I believe it was like 8.86% in the previous example. The reason that we've dropped our effective weighted average cost of capital from the one problem to the other is twofold. This problem has a higher tax rate, 40% versus 30%. So hence, we're getting a bigger subsidy on our income taxes. The higher the tax rate, the more beneficial it is to issue debt. This company, realizing that benefit, upped their target structure to 60%. So maybe you'd issue more bonds if the tax rate was higher. So one of the things that we should get is a couple of years ago when we dropped the federal tax rate down to 21%, we are reducing, even though the corporations are getting a lower tax rate, which is overall good for them, the subsidy to debt dropped. Nobody really talks about that. But since your tax rate is lower, your subsidy isn't good. If firms were paying 40% and now it's only a 20% tax rate, this 9% times 1 minus 0.2 would be 7.2%. So if the tax rate is 20%, roughly what it is now, a 9% bond times 1 minus t gives us 9% times 0.80, which is 7.2%. So the cost of financing using debt to corporations has increased the last couple of years because of the drop in the tax rate. They're not going to complain because the drop in the tax rate means all their earnings are taxed cheaper, but we don't subsidize their debt financing as much, something you don't hear about in the press, okay? All right, so what have we learned? These are long-term perspectives. You don't change them from time to time. In an individual year, this is important, you might issue more than your target share of bonds. You might issue less. You might issue more or less of either of the types of stock. You're taking advantage of current situations. Currently, depressed stock prices, low interest rates, issue more bonds, less stock. Market back at 30,000 on the Dow, you might want to then sell some extra stock, cut back on the bonds that you're issuing. Tesla did an excellent job on this, okay, in the last year. They issued some of both. When their stock price was low, they piled in on the stock, just sold stock when their stock price went higher, okay? Hopefully we don't have any questions on that, but if you do, just email them in. All right, I'm still waiting for my first email from the Chapter 9 video. Okay, all right, that was only put out yesterday, or actually this morning. All right, so we have this done. All right, now to get into a couple of other topics in our Chapter 10. Well, if I erased this before you got to write it down, just roll the video back. Okay, here's a term you have to be familiar with. Flotation cost has nothing to do with a device you might use in the pool. Okay, flotation costs are the reason you're taking finance class, because you're hoping to become an investment banker at Goldman Sachs or an investment banker at Merrill Lynch. Those people make a lot of money. Men and women that work there, putting deals together, selling bonds, selling stock. Remember way back when we said these people go on road shows, they find investors interested in investing in your company. All right, so you as an investment banker, you didn't come here and pay all this money to go to school and learn all this stuff I've been teaching you to go out and work back at Starbucks. You want to get into a firm, maybe U.S. Bank, okay, maybe it's a Goldman Sachs or a Merrill, and you're going to help going out on road shows, showing your analysis of what stocks are valued at because you used your Chapter 9 data, the corporate valuation model to figure out what the company's worth. You want to sell some stock or bonds on the company's behalf. You want to get paid. Here's how you get paid. Through flotation costs. What does flotation costs mean? That means if you value a company's stock at $40, and you're able to round up investors on the IPO to buy their stock at $40, or maybe it's a secondary offering. They've already issued shares in the past, and now you're going to sell more shares at $40, okay? That's great. But you charge a flotation cost, let's say, equal to 5%. That means when you sell the stock to the investors and they pay $40, the company gets 1 minus F. That's the flotation cost. So they get 40 times 1 minus 0.05 in this case. That's 40 times 0.95. They get $38. So the investment bankers rounded up investors to give the company $40 a share. The investment banker got to keep $2. So if you just sold 10 million shares, you just got a $20 million fee for raising all that capital for the firm. Not bad, okay? So flotation costs reduce the amount of money that the firm selling the stock, it'll be common stock or preferred. We can talk about bonds also. But in this chapter, we just impact common and preferred stock with the flotation cost. Okay? So flotation cost, simply multiply P0, the amount of the value of the stock, by 1 minus F to get $38. That's what the company gets, the investment banker gets the balance. So let's see how this influences problems that you're going to have to do. Remember flotation cost? Come to fruition when an investment banker helps sell common or preferred stock. Okay? The other way that you raise money is through your profitability or retained earnings. Okay? So just when you make profits, you can also use that money to invest in your company, repurchase shares, or pay dividends. When you sell stock, you're selling stock because you're going to use some of that money maybe to pay dividends, okay, maybe to invest in your company. All right? Well, what we're going to do then is realize there's two different things going on. The cost of capital increases if you use an investment banker. Because that P0 we just had of $40 basically dropped to 38 because that's what you got. All right? In retained earnings, there's no cost of capital. Excuse me, no flotation cost. There is a cost of capital. All right? There's no flotation cost because that money comes to you from your profits. All right. So let's try a couple of problems. First, let's go with preferred stock. Say you have a preferred stock. It pays you a $4 annual dividend. And you sell the stock for $100. The investment, okay? You didn't use an investment banker. You did it on your own. That's 4 over 100. That means the cost is 4%, 4 over 100. All right? The investor earns 4%, and you earn 4%. So the RS of this preferred in this case, with no flotation cost, is 4%. The investor gets 4%, you pay 4%. Now let's change it. It pays a $4 dividend. You're going to sell it for $100. But you're going to give the investment banker a 4% flotation cost fee. That's what they're going to get. So now what? You get the $4 times 100 minus 1 minus F. $4 divided by 100 times 1 minus F. That's $4 over 100 times 0.96. So that's 4 over $96. That yield is roughly 4.17%. So let's think about this for a minute. The cost of capital for this preferred is 4.17%. The investors still only get $4. They still paid $100. They don't know that part of the fee went to the investment banker, that the firm only got 96. They're only concerned with, I get $4 and I gave 100. So the investor earns the same rate of 4%. The cost of capital to the firm, because they use an investment banker, goes up to 4.17. Okay? So you would use 4.17% in this case to understand what your cost of the preferred capital is. So we always say RS has to equal RS from the investor and the firm issuing the stock. This is the exception. When there's a flotation cost, your firm issuing the stock has a higher fee to pay, which means they have an interest rate that's higher than what the investor gets because of that fee. Okay, let's try one more. Let's say this is another preferred with an $8.50 dividend, and maybe this preferred sold at $98, and there was a flotation cost equal to 6%. So that would mean you would get, as the firm, $98 times 1 minus 0.06, that's $8.50 divided by 98 times 0.94, that becomes 850 over 9212, which is 9.22%. Okay? The investors who put in who get $850 for their $98 investment, they earn 8.67%. The investor gets $850 for every 98. This is what the investor rate, that's what they earn. Your cost of capital on the preferred is 9.22%. Okay? So you should be able to figure out the cost of capital in regards to the preferred with a flotation cost or without one. Without one, it's going to equal what the investor paid. With one, it's going to be a higher rate than what the investor earns. Questions, send them in. Video questions are accepted also. All right, but you could just send me a normal one. Don't forget also to turn in your Chapter 10 homework. By now you should have gotten your grade back on your Bloomberg assignment. Project 2 should be probably well on its way, if not submitted. Okay. One last thing we have to start worrying about is how to calculate the cost of capital for a stock when there's a flotation cost. All right? So we should remember our dividend growth model. P0 equals D1 over RS minus G, which we can also rewrite as RS equals D1 over P0 plus G. This is your dividend yield. This is your capital appreciation or growth rate. So when you get a homework or test problem that has all kinds of information in it, and in the end I ask, what was the capital appreciation rate? Don't do any math, just tell me it's equal to G. Whatever G is, that was your capital appreciation rate. D1 over P0 is your dividend yield. Depending on the information you had been given, you should know that RS minus G is also the dividend yield. Okay, the investors want to earn a dividend yield and a capital appreciation. All right? Here we're figuring out the price of the stock today, P0. Okay. So to figure out what the firm is going to pay in terms of cost of capital, okay, or RS, okay, when there's a flotation cost, we're going to make an adjustment to this formula. 1 minus F. P0 times 1 minus F. Let's write that a little larger. RS equals D1 over P0 times 1 minus the flotation cost, then add G. They don't get the price of the stock, they get something less. Okay? So let's do a problem. Maybe we'll do two. Given D1 equals $2, P0 equals $30. Your G, or your capital appreciation, is 6%, and your flotation cost equals 5%. What is our S? Since we already know what D1 is, then it's going to be RS is equal to $2 over 30 bucks times 1 minus 0.05 plus G. What does all this come to? RS is equal to $2 over 30 bucks times 0.95 plus G. 30 times 0.95 gives me what? 28.50. $2 over 28.50. That's your dividend yield plus your capital appreciation. 2 over 28.50 is roughly 0.07 plus your growth rate equals 13%. Okay, this was D1 that was given. Price of the stock is given. The flotation cost is given, so we're only going to get 95% of the 30. Where does the other bucket and a half go? It goes to your fee as the investment banker. The firm only gets $28.50. That means their cost of capital is 13% that you would use for the cost of capital associated with a new offering. Questions? Concerns? Everybody awake? I don't want to have to throw a marker again. Okay. So erase that. This we should know. Let's say instead of D1, you're given D0, the dividend today. You're told the dividend today is $3. And your growth rate equals 5%. Flotation equals 3%. The price of the stock today is 40 bucks. We need to calculate D1. D1 is equal to D0 times 1 plus the growth rate. D1 is equal to the 3 bucks times 1 plus the growth rate, 1.05. That means D1 is $3.15. Okay, now that we know that, we can solve the problem. $3.15, RS is equal to our dividend over P0 of 40 bucks times 1 minus the flotation cost, 1 minus 0.03 is 0.97. Don't forget to add in the growth rate. That's like the thing that everybody forgets to do. 0.05 is 5%. All right, 315, 40 times 0.97. That gives me 315 over 38.80 plus that 5%. This is your dividend yield, which comes out to, what's my dividend yield? 0.081 I have. 0.081 plus 0.05. That gives me a 13.1% RS. Cost of capital, issuing stock, paying a 5%, 3% flotation cost with a 5% growth rate. Okay, so we should now be able to calculate the weighted average cost of capital for a firm using the after-tax cost of debt. We should be able to calculate the after-tax cost of debt. Okay, we should be able to calculate the cost of capital when you issue shares with a flotation cost. Chapter 9, we were figuring out the cost of capital of stock without a flotation cost, which is also what your retained earnings cost you, okay? And we calculated preferred stock. We know what the investor earns, and we know what the firm pays. The firm pays a higher rate when there's a flotation cost, okay? The other thing that we should remember, you may need to get your RS from the CAPM model, okay? The risk-free rate plus the premium to the market times beta in some of these problems. The other thing that you may have to do is when you're figuring out what your after-tax cost of debt you might be given something that looks like the following. See if we can go all the way back to chapter 5. You might be given present value is 980. The N equals 10. Payment equals 50. Actually, I think I changed this to 930. 10. Payment of 50 and a future value of 1,000. You'd plug this into your calculator to calculate the yield. The yield that you get would be, I believe, 5.95%. So when you price the bond to calculate a yield, that's your before tax cost. Okay? So if there was a 30% tax rate, this is your before tax cost of debt. Your after tax cost of debt is 5.95 times, if it's a 30% tax rate, times 1 minus 0.30, 5.95 times 0.7, you should get 4.165. That's what you would use in your after-tax cost of debt. So now, hopefully, you are seeing how the entire text came to summation in chapter 10, okay? Way back when we were using free cash flow, okay? In the free cash flow problems, we had to use weighted average cost of capital. Now you know how to calculate the weighted average cost of capital. It doesn't have to be given to you anymore. With chapter 5, we priced bonds. Now we know that we could use how we price bonds to figure out our before tax cost of debt. Understanding tax rates, we can get the after-tax cost of debt to calculate that weighted average cost of capital. Chapter 9, we were pricing stocks. Okay, using a dividend growth model. Now we're adjusting that for the flotation cost. All right, earlier chapters, we talked about making your company riskier by having too much debt on the books. We see how that influences us. The more debt you have, the more investors are going to want an interest rate. We've talked about macro events. Lower interest rates mean companies would be more likely to issue debt. Lower tax rates takes away some of that subsidy, so it's less advantageous to issue debt. Okay? All those things are things we learned. 2 essay questions. Good thing about essay questions now, if you forget what I told you and didn't take notes and didn't pay attention during class, okay, they're on the notes. The test will obviously be open book. Problem with open book tests, they're always harder. Why? Because you sit there thinking you didn't have to study. And you flip through the pages, and you flip through the notes, and you're a nervous wreck, and all of a sudden you look up, and I said the test had to be mailed back by 9:15. It's 9:16. 0. You got to get it back on time. So you can't just rely that you can flip through the books and the homework. There will be a hard and fast time. Emails not received by that time on the day of the test, done. I can't play a game with that, okay? It's too much exposure, all right? So, 2 essay questions. First of all, you need to know what flotation costs are, but also there's controllable and non-controllable events that influence your cost of capital. Let's talk about them. Things that are controllable. You can control how much your dividend is. So when you set a dividend, that dividend is figured in your cost of capital. Okay? The higher the dividend, the more the cost of capital. The lower the dividend, less. If you cut the dividend, you reduce your cost of capital in theory. Okay? So the amount of the dividend you pay, that's controllable. Your target structure, 50-40-10, 70-30, no preferred. That's within your control as a CFO or CEO or the board of directors. So setting your target structure is a controllable event. The type and terms of the bonds that you issue. You decide, are you going to issue floating rate or fixed rate, 5-year, 10-year, 30-year bonds, or are you going to just sell commercial paper? Okay? All of that will influence your cost of financing. Controllable, your firm decides 5, 10, 30-year bonds, fixed rate, floating rate. That will impact the rate that you're paying, okay, to the investors. Okay? Are you going to issue preferred stock that's cumulative? Or are you issuing preferred stock non-cumulative? Are you even issuing preferred stock? That's your decision. All right? Capital budgeting also influences the cost of financing. If you're a firm that's constantly acquiring other companies, investors will understand that, okay? And there will be a cost for that. That's your decision. That's under your control. Things that are not controllable. The tax rate overall for corporations. You don't get to set it. It was close to 40%, it's now 20%. Who knows what happens this coming November? Depending on if the administration changes, it might move back up to 28 or 30%. We don't know. That's not controllable. Interest rates are not controllable. Okay? The Federal Reserve, in supply and demand of loans throughout the economy, will move interest rates up and down. That affects your cost of financing, not controllable. All right? General market conditions. Coronavirus sent the market into a tizzy. If you were planning on selling stock, you probably changed your mind. You probably sold bonds if you were a better rated company because you got a better interest rate. Market conditions influence the cost of financing, but the conditions themselves are not controllable. Okay? Understand the difference between controllable and non-controllable, and be able to give a brief sentence about a few of those items when you get to your test. You must have your chapter 10 notes handy. Okay? One thing you should realize is you don't need to spend an entire paragraph explaining each one of those items. A brief sentence on each one will suffice generally. When you're writing a paragraph on something that requires a sentence, you probably didn't know the topic well enough. So be able to concisely distinguish between controllable and non-controllable events. Be able to define flotation costs. Send me an email. I'm going to call it a day. Maybe. I might be back later for Chapter 11. Look for this video tonight, which is actually March 15th. Have a great day.